Today I have a video with the 15 best signals when it comes to price action, pattern trading, but we're also going to take a look at trend trading and how to find the best trades overall. So without wasting any time, let's just jump into the charts. First of all, the breakout. And when you're looking at a channel, what is a very important signal on a channel is when the price exits the channel, especially in the right context. Let me get rid of this one. And then we can see the price has been moving lower. We have here lower lows, but then on the channel we are making higher lows. We are trading back into the top side of the channel. And the last thing that you want to see in a downtrend is obviously the price breaking out of a channel with strong momentum. You can see previously the market had this resistance area here that the price was never able to break below that. It acted as very strong resistance, but then the resistance and the trend line broke, the market traded above the channel, and this is often a signal that the ongoing previous downtrend is over. What you can then do now is wait for the retest. And very often resistance turns into support. So I keep saying this video after video. I do not recommend trading regular breakouts. So jumping on the breakout here is something that many traders do. It may work. It is much more difficult to apply in 2022, 2023 because the tendency for those retests is just so high. What I would recommend instead, wait for the retest. Wait to see where's the market finding support. Are we falling back into the channel, which is also not very uncommon. But what you want to see is if you are looking for long continuations, wait for the market to establish a clear support level. We have it here twice, 2 support touch points. We see strong momentum, and this is where you want to get in. You don't even have to necessarily wait for the market to get back above this high. If you see such strong momentum coming into the market, we have so many things now pointing into the long direction. We have the channel that has been broken, we have resistance that's turned into support, we have a double bottom here, and we have strong momentum. Even if the high is not broken, that's the only negative confluence that we have. We have so many positive confluence. One negative confluence is usually not enough to outweigh the positive sides. Then you can see afterwards the market trades higher and the trend really gets going here afterwards. You can see I added the 50 period SMA, which is also here acting as a support level. So many things pointing towards long, and we can very nicely see how this previous downtrend gradually shifted towards an uptrend. I love using indicators in unconventional ways, and here I added the stochastic and I deactivated the D line. We're only looking at the K line here, which is the heart of the stochastic. And what you can often do is do the stochastic riding. When the stochastic enters overbought, this is not a bearish signal. A lot of traders believe that when the stochastic goes into the area above 80, which is called overbought, many traders believe that the market will reverse. This is often not the case. If you look at the stochastic formula, and if you go to my YouTube channel and search for stochastic, I made some videos about just deep dives into the stochastic, you will see that a stochastic over 80 means you are looking at a very, very strong uptrend. And very often you can see when the market and when the stochastic stays above 80 or very close to 80, that's where you often find very strong trends. Here the opposite is true. The market has a downtrend. As the downtrend gets going, the stochastic here dips below 20, which is called oversold. And this is where the real downtrend then gets started. So I would recommend start paying attention to the stochastic, but not in the conventional way where you trade against the stochastic. Look how you can use it for trend trading. Here another example, the market goes down, the stochastic enters here the oversold, and then the market keeps going and going. And you can see it stayed below 20 for a long, long period of time. You can also add other confluence, obviously. You can add moving averages. Here I'm adding the daily pivot point, and we can use the daily pivot point as another trend filter. We have the stochastic below 20, the price is below the daily pivot point, and as long as this is the case, the market moves lower and lower. So this is a way how you can improve your trend trading and just get additional information. The ADX is also a very important trend filter or trend indicator. Here's the ADX 14 period. And what I did is I added this horizontal level at 30. This is typically the threshold for trend trading. An ADX below 30 means that the market is in a range. An ADX above 30 means that you are in a trending market. Also, there are some other caveats. You want to see typically that the ADX is going up and not that the ADX is going down. But you can use the ADX going down if it's above 30 also for pullback trading. And then you can use it in many different ways. Use it, for example, as a filter, as I said. If you see that your market is above 30 with the ADX, typically you're in a trending market and you should look for continuations and not look for pullbacks. If the market and if the ADX is above 30 and going down, like in this case, you're looking at a kind of a pullback, and then you could wait for the market to resume into the initial direction of the trend with the ADX pointing upwards. You can then use breakout continuations, for example, as a filter. Here what we have is the ADX below 25 for a long time, and then you can see previously the market moved sideways for a long time. That's the ADX indicating the range. And then on the range breakout, the ADX goes above 25 and eventually here over 30. And there are different opinions on whether you should have your ADX threshold for at 20, at 25, at 30. You can play around with it and see that different markets at different times respond to different values. So 20 to 30 is usually the threshold. But in any case, it is very helpful to add the indicator also for breakout trading. It's a trend momentum indicator, the ADX, and therefore it helps you identify objective momentum. You can also have two ADX. This is the higher time frame ADX and this is the lower time frame ADX. And what you could be doing is wait for the higher time frame ADX to go into the trend direction, so let it point upwards, and then make sure that you sync the lower time frame ADX as well. So what you generally want to see is that both ADX, higher and lower time frame, are both going up, which means that on the higher and on the lower time frame you're seeing trend signals, and that can be also a great tool and a great filter. Here, for example, as well, it's going up very strongly on the ADX on the higher time frame, and then what you do is you wait for the dip on the ADX on the lower time frame to be over, and you wait for the ADX to point into the trend direction. And then you can see when those two are in sync, when they're both going up at the same time, you're looking at strong trending markets. Again, use a trend filter threshold on the higher time frame ADX so that you can distinguish between ranging markets and trending markets. What I absolutely love as a trend trader are flags. I think they are very underrated, but I think they are one of the most important patterns in trend trading. And flags really help you understand the trend dynamics. A flag pattern is usually a consolidation pattern. So a flag is typically a sideways phase with a very low angle. So the angle here, the market is going up. Yes, you can see that the market is going higher, but it's going higher very, very slowly. In a long period of time here where the flag is drawn, the market goes up only a few points. Contrast it to what has happened before the flag. Before the flag, the market was going down very, very strongly. This indicates a strong trend, whereas this indicates a weak trend. So we can assume that the selling side is much stronger than the buying side. And this is a very important piece of information. Knowing that the sellers are the dominant force helps us to understand, first of all, we want to look for short opportunities, and the flag helps us time our trades. We want to get into trades when the flag is broken, when the market makes a lower low, breaks the lower trend line and continues into the trend direction. We can then very safely, not 100%, but safely assume that the next trending leg down will be also much stronger, like in the first example, not as shallow here. And that's what we want to trade. We want to get into trades where the market moves a lot in a short amount of time. And you can see this is what happens. This is where we started, the weak consolidation flag, then very strong continuation. Then here, sideways consolidation. In this case, we don't even have any angle. Here at least we had a little bit of an angle, but here there's no angle at all. Very weak consolidation, no bullish power. The market just rested sideways until the sellers resumed. Here you can see breakout, retest, and very strong continuation. And this is often how markets move. Another very important feature and characteristic about trending market is that sometimes you have a trending market and then the market goes sideways. Like in this example, it goes sideways, but when the sideways period goes on for an extremely long time, the likelihood of a trend continuation is very low. And we often then call them distributions. They're not consolidations anymore. A consolidation is a market period where the market rests, goes sideways, has a flag, and then continues. But a long sideways phase has a very, very low likelihood of continuing into the trend direction. So the longer a sideways phase goes on, the higher the likelihood is that the market eventually returns and reverses into the opposite direction, like it did here. You can see strong trend, very, very long distribution pattern, almost probably 3 or 4 times as long as the trend, so very, very long. Then you have the breakout buildup. I will come to that in a moment. And then you can see the market returns and reverses into the opposite trend direction. So the length, how long the market is spending sideways is also quite important, especially if it happens after a long trend that has been already going on for a long period of time. The breakout buildup is one of the most important add-on patterns. So what you have is a downtrend on the left. The market goes into a long sideways distribution. We have the double bottom, and after the double bottom, the market is never able to reach this low again. We move higher, we move back into the resistance area, and the price really sticks to the level. You can see, whereas previously, after reaching the level, we had a strong sell-off and we stayed away from the level for a long time. Now the market comes into the level, trades away, and is immediately back, trades away a little bit, and is immediately back. Then we trade around it, and then we break out. So strong trending market goes over into a long-term distribution, which already makes a continuation not as likely. Then we have the breakout buildup, which is a very strong bullish signal. Then the breakout, and then the price reverses. Another of those reversal patterns is the so-called 1, 2, 3 pattern. In a healthy trend, what do you typically see? Typically, you see that the market is making lower highs and lower lows. Here on the top side, you can see a high, a lower high, and a lower high. Here you can see the lows, a low, lower low, lower low, and so on. If this changes and the market suddenly breaks above a previous high and doesn't make a lower high, but makes now maybe a higher high, then we are waiting for our 1, 2, 3 pattern. 1, 2, 3. So the low is the 1 of the trend, then 2 is the end of the next trend wave, which is breaking the previous downtrend. You can see this was our previous lower high here on the way down. This is now a higher high, and this is our wave 3, or point 3 rather, in the 1, 2, 3 pattern. And then you often have reversals. Point 3 is very often corresponding to the previous low high here. You can see that this is the lowest high, and then you can see previous resistance here turns into support. I've mentioned many times, and it's such a common pattern. I will come back to this in the later part of this video when we take a look at Fibonacci's, because this is exactly where you want to trade Fibonacci's. You put your Fibonacci from 1, 2, 3, and then you get the target automatically from your Fibonacci. But stay around, and I will show you in the end of this video how this is done. Another trend trading indicator is the MACD, and the MACD is basically a moving average crossover system. It's a very great tool to have, and what you want to do and what you can do, for example, is pullback continuation trading. So we are here clearly in an uptrend, the market is moving higher, and we have a consolidation here, kind of a flag pattern. And what you see during the flag pattern is that the MACD crosses. You can see the black line is above the blue line, which is a bearish signal. Whereas here on the way up, you can see the blue is above the black. You can also see here the MACD histogram is green. During the consolidation, you see that this changes, the MACD is red, and the MACD lines have crossed. Now, what you want to see, if the market resumes, breaks out above the highs, what you want to see is that the MACD histogram turns green and the two lines cross as well back into the bullish mode. You can see this is happening now. We have a MACD that is positive, green histogram, and the MACD lines cross as well. We are above the channel with a strong breakout candle. This is now a continuation signal based on the MACD. And you can see afterwards the MACD resumes green. Even though sometimes the MACD histogram declines, that shouldn't be a worry for you as a trend trader. As long as the MACD is green and as long as the MACD lines here are separated, that's typically considered a bullish signal. And you can see very nicely how the trend unfolds. This changes now. You can see the histogram is turning red and the MACD lines have crossed again. This means that the trend is showing weaknesses. With our pure eye, we wouldn't be able to detect the weakness as clearly as we see it now on the MACD. But this is really the beauty of the indicator. The indicator provides objective signals that otherwise we would often miss using our just subjective information here from the charts. And you can see afterwards the MACD was right, the price has turned around. We see strong momentum into the opposite. If you have been trading this to the upside, you'd be glad to be out here already and not have to give back so many profits here when other traders are probably running for the door and exiting the trade. In general, I think it's very, very important and very overlooked to understand which trend stage is the market that you're looking at currently in. And we have to distinguish between early trends. So the trend is just starting and we are coming maybe from a downtrend here on the left. Then the market is breaking into new highs and we're starting a trend, to an established trend where we know the market has been going up for a while, but the trend hasn't gone on for a long period of time. And we have a mature trend where things are often already slowing down kind of, where everybody is understanding that we have been trading for a long time. Also, the traders who bought the market very early in a new trend are sitting now on a lot of profits here in the mature trend stage, and this makes profit taking more likely. If the buyers who bought in the early and the established trend are exiting their long positions, this means they have to get into a short position and they need to unwind the long position. This adds to the bearish pressure. And in a mature trend, you will often see slowing down. And one of the most important implications of that is that you look for different trending signals and strategies in the different trend stages. When you're in an early trend, you want to look for breakouts. Typically, you want to look for breakouts out of an accumulation or is the distribution, as I've shown you. In an established trend, you typically want to look for pullbacks. For example, here we could probably find a flag pattern and then trade the break and retest out of the flag pattern. In a mature trend, you want to trade trend reversals. You typically don't want to bet on the trend continuing because the likelihood is just much lower that the trend will continue after it has gone for a long period of time. So this is the most important implications of trend stages, and depending on the trading strategy that you're choosing and the type of trader that you want to be, you have to make sure that you look for your trades in the right trend context. For example, a head and shoulders is often a trend reversal signal. Typically, a head and shoulders shows you that the market is going from higher highs and higher lows on the left to then from the head to the right shoulder, we have a lower high. And that is often a signal that the trend is losing strength, especially then if you fall below a support level, when suddenly support is turning into resistance. That's then it's a sign that the market is rolling over. So a head and shoulders trader, for example, or a breakout trader would typically look for those patterns in a mature trend, not in an established trend and not in an early trend. Here, for example, we have a trend line. The market has been going down here. Then we turn around, started the uptrend. The uptrend has been going on for a while. Here we see slowly signs that the market is not able to push higher as easily. We have here a lower high. We break the trend line, which is a clear sign that something is changing. We have the support level that's turning into resistance, and now we roll over. So you can see a head and shoulders or a trend line breakout in this context at a mature trend makes so much more sense than if we would have looked for it in the early beginnings of a new established trend. We can also add obviously other helpers such as the moving average. You can see the moving average helps us distinguish between trending phases. We trade around the moving average. That typically means that we are in an early trend stage, especially if before that the market has been trading below the moving average. So we probably are coming here from a mature trend stage here. We roll over, start our trend, and then you can see as the trend moves back into the moving average, that's where you look for then reversal strategies based on the mature trending strategies. As I said, I want to come back to the Fibonaccis, and Fibonaccis are great for continuation trading. So you typically want to try to trade Fibonacci continuations either early on or in an established trend, not in a mature trend. And what you need is those A, B, C. As when we talked about the 1, 2, 3, it's the 1, 2, and then the 3. And the goal is then that we trade this area. This is typically the established trend, or just still can sometimes be late in an early trend. So still we are not in a mature trend whatsoever, we are still quite early. And then you look for that A, B, C, or 1, 2, 3. You use your Fibonacci, point A to point B. You have your C retracement 50, and then you can use the Fibonacci extensions for your targets. 161, 200, 261, and you can see after 261 the market moved sideways for many days, and you're glad to be out here. And if you're interested in Fibonacci's, I made a video recently on my YouTube channel, which is free obviously. So you just search for Fibonacci's if you want to learn more about how to use this really amazing trend trading tool. It's ideal for those early trend continuations, and very often you can catch great trading opportunities with that. And that's it for today's video. I think we covered many different concepts, ideas, strategies. If you like those mixed videos where I not only talk about price action or not only about indicators, but kind of mix it, then let me know in the comments below and I will make more going forward.